Hey everyone, hope you're having a good day. My name's Andy. My channel's Finding Value. We're going to rip through Twitter like we normally do. Uh, Generally speak about three different topics: wealth building, commodities, and/or financial topics. So let's see what people are sharing on social media. Let's dive in there, and I'll make my financial opinions as we go. You can follow me at finding_finance, or you can join our community, finding-value.com. That's where we go over trainings, individual sectors, companies, technical charting. We do a whole bunch of stuff. I'm a hybrid investor. I don't rely solely on technicals. I've got the three-pillar approach, which deals with technical analysis, ratios, and market conditions. This weekend, we'll be going over um, valuing, not really valuing, but looking at companies and how commodity companies make money, how it ties to you as an investor or a shareholder. And I've also got a natural gas presentation so you guys understand the natural gas markets. Okay, let's dive into this. So, Warren Buffett says risk comes from not knowing what you're doing. And I would agree with that. If you know what you're doing, you know the market conditions, you know the companies and how they make money and all this other stuff, it makes sense. You can select the proper companies, you know what conditions they're going to be making a lot of money under, uh, and you kind of tie this whole thing together. If you don't know any of that, there's a lot of risk because you don't know what you're doing. You don't know how to select the companies. You don't know what sector to go into and when. Yeah, there's a lot of risk with that. I totally agree with Warren. Here is electric cars rapidly lose their value. So this is the annual price drop by fuel type. Diesel and petrol being the best and electric being the worst. And I think that deals with all of the software and electronics tied in with the batteries. So people don't want to be buying an 8 or 10-year-old vehicle that's electric where the batteries could go bad. And I know the costs to replace the batteries are exceptionally expensive. Maybe it gets better with time, maybe not. I kind of look at it. I kind of look at an electric vehicle as the battery in my vehicle, and I've been through three batteries, about three batteries, I think, on the car that I currently own. I purchased it new in 2005. So three batteries since 2005. That's pretty good. Did Buffett just trim Apple? Am I reading this right? So let's look at what he's trimming and what he's buying here. So there we go. We've got adding to Cirrus, Chevron, Occidental Petroleum. So he's buying the oil companies. He's trimming Apple, Paramount, HP, DR Horton. It looks like he sold out of that. Merkle Group, Stoneco, and Globe Life. So he's adding to oil companies. I like the oil companies too. Here's Paul speaking about natural gas. He says, remember when we had over 900 billion cubic feet surplus and price was still $2? Now the market won't let storage stray very far from flat without absolutely freaking out. Why? Because storage capacity hasn't grown with demand, which means less spare capacity for variance. And this is where he's using the Henry Hub price versus the deficit. You can see an outlier in 2022. We had a little bit of a deficit in terms of here's zero, there's the deficit of 200 of inventory relative to the previous year, and prices went ballistic during that time frame. And you can see kind of the average area where the majority of price falls. As time goes on, our inventory levels are not expanding at the same rate that our demand is. So your days coverage of where you're at inventory wise is declining because your demand is rapidly increasing and the supply to that demand is being able to cover less days. So as we draw inventory and we go below particularly averages, you can't compare today's inventory levels to like 5 years ago because we have a lot more demand for natural gas than we did 5 years ago. So your inventory in terms of days of coverage is shrinking using the same inventory levels that we have today. Your flow rates are increasing basically. Time frame from dropping a rig to it showing in volumes is 6 to 7 months according to Comstock. No surprise there. So I know some people are asking, why would someone add a rig? Well, they need to add a rig today to get the volumes up 6 to 7 months from now. This stuff isn't immediate. You don't just drill it and it just happens to come out immediately. You got to move the rig there. You got to prep it. There's all sorts of stuff that occurs, and that takes a lead time to show volumes in 6 to 7 months. Here's former Home Depot CEO sounds alarm on tremendous shift. Let's see what they're talking about here. A former top corporate America executive is warning that the U.S. economy is not on fast track to recovery, as higher inflation and more mass layoffs loom over markets. The general population will not be duped by this aversion to try and blame inflation on corporate America. It starts at the raw materials. It starts at transportation. It starts at energy. Former Home Depot and Chrysler CEO Bob Nardelli said. He says a whole host of things that are driving this up, wage increases. We're not seeing people being laid off, he continued. If you look at chips, they've laid off. He said, we're now seeing people being laid off. If you look at chips, they've laid off almost 40,000 people. We're seeing a tremendous shift in employment out there where people are being laid off. So maybe we do have a slowdown that is coming in the mix with all of these layoffs. Here's Mac 10. He says last time Japan's stock market outperformed the rest of the world was 34 years ago in 1990. And then it spontaneously exploded. This is that Batman pattern. You get the ear, the little mid-cycle thing, and then another ear, and then it basically implodes. I think the S&P and the NASDAQ are putting similar things into this. Maybe not exact, and maybe the timing is off, but I think we are doing something similar to this in terms of valuations, especially. Below, Alliance Bernstein shows that 80% of all 10 baggers were profitable and traded at a PE of 14 to 17x. Now Bank of America showing that 80% of stocks' long-term return is driven by the starting valuation when you go into it. Buffett knows this and pays less than 15 times forward earnings. So 80% of stocks' return can be explained by starting valuations. That is why, if you notice, if you guys are members on the website, you know how I always talk about the valuations? We look at the sector valuation, and then I always talk about, and I know you guys probably get annoyed maybe with it sometimes. I always talk about enterprise value to cash flow. Enterprise value to cash flow. Our PE is way less than 15 times forward earnings. We are like at 1, 2, 3, 4 times forward earnings in a lot of our companies. This is how we're going to get the big returns over the next 5 to 10 years. It's the starting point that you're buying the stocks at. And it's not just that. We are buying out of favor stuff at ridiculous valuations with good technical chart patterns and with the tailwinds behind the things, the commodities that are about to go up. So it's not, you're getting in the ballpark of a good entry point with a very cheap company with good technicals in terms of a bottoming stage analysis or a potential entering of stage 2. That's exactly what we're looking at. And this is exactly how Buffett plays the game. This is the evidence behind that. So being cheap to cash flow, being able to look at the operational cash flows, you can't really count for those. Accounting can't make that better. That's why some of these things that we use to basically identify the potential cash flow from a commodity from the commodity going higher, I should say, is so important. And I'll train you guys this next question and answer session on exactly what I look at and how I do it. Coming on down. Permian oil production is flooding the natural gas market because even if oil production is flat, natural gas production grows thanks to higher GORs. And that's gas to oil ratio. Increases from higher crude production. So I know some people had asked me some questions, or I saw it on the Discord of, why am I so bullish on natural gas? And if we're going to be drilling more oil, won't more natural gas basically come into production? I think we need to understand the demand that is coming for natural gas. I want you to look at how many power generation gigawatts are coming. We're going to go into all of that stuff. And you'll see also that producing oil from certain areas also consumes copious amounts of natural gas. So you have to envision the future before it occurs and position yourself for that future that you're envisioning to materialize. That is really that's what I'm doing. That's how I'm making the money. Here's one for the Dow theory enthusiasts, and this is Dow Jones Transportation. Oops, and then it came back, but this could still go higher. It could be squeezing into a triangle here, and it's just some resistance. So yeah, we got the RSI coming back down. I get it. But let's see if this thing squeezes up and breaks, or if it actually turns and rolls over. If we get all that unemployment, this would turn and roll over. Very much be the case. Here's oil. This is an update. So it tried to pop the inventory bull plot, but smacked down with timely surge in U.S. crude inventories. So it's a inverted shoulder, head, shoulder that's trying to pop out of this. And that is that resistance neckline that we're at. So this is one to watch. If we break out of this inverted head and shoulders, I think it will be the beginning of potentially a good move higher for a period of time. So that's what I'm looking for. Peter Schiff says if the Fed really was data dependent, no one would be trying to figure out the timing of the first rate cut. The Fed would have already raised rates again and would be indicating more hikes to come. The real agenda is propping up markets, the banks, and election year politics, in his opinion. Here's the EIA weekly oil report. Total U.S. oil inventories are lower than in 2023 and in 2022. They are not increasing at the rate of 2023. Inventories should be near the winter peak. So here's 2024. We're down here. And you can see that we are below 2023, which was a really low total U.S. oil inventory year, which is below 2022 and below 2021. So the question is, why are we not priced like 2021? Why are we so much lower in oil prices than these previous years that had more oil inventory? Is it the deficits that were causing this? Because we're still running deficits. Is it the market conditions where we had an increasing interest rate environment and money rotated into oil? That is what I think is the case. Ding, ding, ding. And I think people are expecting a decline in interest rates, and that may cause not as much money to rotate into oil. But when the inflation kicks up and the interest rates start to move, that's generally when oil does very well. Or conversely, when oil prices go up, interest rates follow higher, and then more money rotates into it. You could call it a flywheel effect to some extent. Natural gas at a 28-year low. This is when I start to get really interested in a potential investment, is when you get to these lows like this. And if you do any sort of ratio analysis, natural gas is off the chart cheap to a lot of different assets. Crude oil seasonality, you are here. Just remember that we are potentially working our way up in terms of crude oil seasonality. And that will also help breaking out of this inverted head and shoulders to the upside. We are coming into seasonality strength. This is more oil. Comparative inventory using EIA weeklies through 2/9/24. Total commercial petroleum stock build of about 5.2 million barrels of oil equivalent. Calculated WTI fair value of $80 with this dot plot that he's got. With current price at $78, $2 undervalued. So the fair value, given where historical valuations are in relationship to inventory, is $80 at this time. Scrolling down, TLT, Treasury bonds slip below multi-month support today. Typically does not bode well for equities. And there's that breakdown. And that breakdown correlates with an increasing interest rate environment. Increasing interest rates likes to rotate money over into oil, which is now coming into seasonality strength. Catch my drift how I'm adding up all of this information and making a case. Global demand for liquefied natural gas is estimated to rise by more than 50% by 2040, as several Asian countries use more LNG to support their economic growth. This is where a major driver is. I understand that we've got a little bit warm weather. We've driven natural gas to extremely low levels. We're probably going to cut back production in the United States. But you know what that sets that up for? If demand continues to grow, and this is where this demand is going to continue to grow, we've got LNG terminals coming online second half of 2024. And if we pull back on production in the beginning and middle of 2024, this is setting itself up for a big spike in natural gas in 2025. So that's kind of how I see it. There's also other reasons that can drastically increase demand for natural gas from electricity power burn. I'm also looking deeper into that. Here's line go up, and this is USO divided by the S&P 500. Are we going to move to the upside versus XLE and SPY? Are we getting a bottom in energy where the energy sector is going to start to outperform the S&P 500? It sure looks like it could. It looks like a bottom to me, feels like a bottom. And this will also, I think, drag upward natural gas companies because they're considered to be in energy stocks. So we could see investment flow, money flows come into the oil and gas sector and move everything up, irrespective of where natural gas is priced today. So it's not just a direct natural gas company or equity goes up just because natural gas prices go up. Its money flows into the ETFs and sectors as well. And I think that is potentially coming here. We've got 2024 core year-over-year inflation versus the 1970s. Does this look familiar? God help the indebted to the hilt mortgage holders if history repeats. We await and God bless. And this is the overlay on top of the 1970s, early 1980s inflation impulse surges. This is a fractal overlaid with the old fractal. Now, I will say we had a housing market bust in mid-1970s. We also had another bust in the 80s. So we had this thing roll up and down, and those busts were also included in these moves. This would indicate that we are close to a bottom where we could go higher in an inflationary impulse surge higher. At 30% of the S&P's 500 market cap, but only about 20% of the anticipated earnings, the tech sector weight is now roughly 8 times that of energy, and an even wider gap than at the height of the tech bubble 24 years ago. So that's just how much money has drifted towards the information technology versus the energy sector. And I hate to say it, guys, but the energy sector is flush with cash. And it's about to be a lot more flush with cash if oil prices move back on up. Lance says, we discussed previously that after the sharp drop in yields in 2023, A retracement to 4.25, 4.5% was likely to reverse overbought conditions. With economic growth and inflation at 3-ish%, once this retracement is complete, yields should start to move toward equilibrium at 3.25% is his opinion. What he's using is Elliott wave analysis, wave 1, 2, 3, 4, 5. An A, B, C correction is what he is proposing. That could be the case because what I see is short-term strength in yields, but that could peak out somewhere in the summer of 2024. It could roll back over in the beginning, late to beginning of early 2025, depending on what that market looks like. But that could be a potential that he sees, and that I would probably say is somewhat accurate. Shell lowers its 2040 liquefied natural gas demand forecast as gas usage peaked in some regions. Global LNG demand will rise 50% to that many tons per year by 2040, which is still strong. Shell previously saw demand topping 700 million tons per year. Shell now expects a supply gap to emerge in the 2030s. So this is the new one that they've got. They think that LNG supply under construction can probably cover a lot of that move for LNG supply. And then there's going to be a gap out in 2030 onwards of the LNG supply. That was the old, but now it's kind of pushed mid 2030s. So what's going to occur here? I think that all these LNG terminals coming online is obviously going to have a much larger takeaway capacity for American nat gas. And it really ramps up second half of 2024. It's right on our doorstep. A 60-40 stocks and bonds portfolio is really just a 100 portfolio because stocks and bonds have been moving together. This cycle's 60-40 has been stocks and oil. Stocks and oil, baby. And I agree with that. It seems like if interest rates go down, S&P 500 goes up. If interest rates go up, oil goes up. I agree with what he's saying. JC's he's pretty much on top of it. Is this normal? Free cash flow divided by price. What would Buffett say? Baba, PayPal, FFC, and JD. Baba looks really cheap, guys. And if you kind of look at this, you can see how cheap this is compared to the free cash flow. That is what a great valuation looks like for Alibaba. Here's PayPal. It's the same thing. Another one where they're way underneath the free cash flow for PayPal again. This is JD.com, way down there in relationship to the free cash flow that it's generating. That's generally what good value looks like. This is the US dollar is hitting 3-month highs, completing this massive base. US Treasury bonds are not a safe haven. If you think stocks are going to fall, then just short stocks. Buying bonds is the opposite of a safe haven. It's the dollar. And the dollar is ready to rip to the upside. What does that mean? Increasing interest rates. Increasing interest rates and the dollar move together. Oil is probably going to go up, is my guess, with that relationship. Rick Rule Rhetoric says, if you look at the arithmetic, nat gas in West Texas commands about 2 million MBTU. That same gas landed in Tokyo and Rotterdam commands 8 to 9 MBTU. And it takes between $1 and $1.50 to get it there. This is a stupid arbitrage. And mercifully for me, nobody cares. I care. I'm in it. This is a huge arbitrage that we can take advantage of when these LNG terminals come back online. And it's not just LNG terminals. We've been on the safe side of warm weather. We get cold weather on top of this with takeaway capacity and increased power burn and coal to natural gas switching, etc., etc., etc. You could see a very big increase in demand for liquefied natural gas, or I should just say natural gas in general in America. I think prices are going to move up, and I think we're at a really good spot. Who says renewables are the cheapest form of power? The levelized cost for electric power from wind and solar with backup is 21% combined cycle natural gas and 44% from coal. So wind with backup is pretty expensive. Solar with backup as well. They're very expensive in relationship to gas at $62 and coal at 52. So they are still more expensive. The renewables are. One of the weirdest tweets I've ever seen, Barrick Gold is not going to zero. I think I've seen it all. But they still have Barrick Gold heading lower in a gigantic um, inverted, we'll say, flag pattern potentially. What they have. Never forget, this time it's different for NVIDIA, and they've got Cisco overlaid, which is one of the biggest bubble stocks back in the 2000 bubble. The number of weekly increases in the S&P 500 is the most overextended it's been in 50 years. While this is just a technical metric, the following sentence from Jeremy Grantham sums up well the current environment. Sustainable bull markets don't start with a Shiller PE of 33 and full employment. Remember what Buffett said, and remember the studies that B of A said. It's always about the initial valuation when you purchase your stocks. What he is saying is the same thing as Buffett is saying. He's saying a sustainable bull market doesn't start with a Shiller PE of 33. It starts less than 15 forward PE. We're at 33. So yeah, something's messed up. We're in a bubble. Stocks are a safe bet, but only if you stay invested long enough to ride out the corrections. And that one I read last time. So that's where we're going to end it, guys. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website if you're interested. We do have some training coming up this next weekend. I'll probably cover natural gas and the setup in some of these commodity companies, how they make money and how it basically translates to you as an investor. So that's some stuff I'm going to cover this weekend. If you're interested in joining, you can use the word LEAP in the coupon code if you'd like. It's a big discount on the yearly membership. All right, guys, that's what I've got for today. We'll catch you next time. This is Finding Value.